Welcome to the Tesla Economist. Please hit the thumbs up and don't forget to subscribe. I often have people telling me that Tesla loses money on every car they sell, and I'm sure many of you have had people inform you that Tesla actually only make profits from selling regulatory credits. I even had to hear this from an actual stockbroker the other day. And okay, fine. The literal truth is, if Tesla did not sell regulatory credits, then they would not make a profit. Although, if they did not receive regulatory credits, Tesla could just as easily decide to make profits by not investing in so much future growth. Personally, I don't mind if they make profits or not. In fact, if they were making losses, it would simply mean they found better ways of growing even faster, as their growth is not currently constrained by cash. Unlike the ideas of some auto companies, who remain nameless, you can't simply throw cash into a business and expect it to automatically grow the way you want. But what always seems to surprise people is when I tell them that Tesla's current gross margins are around 30% on average for each car they sell. We also have enough data to calculate the average selling price of a Tesla. In 2020 Q4, we know that Tesla did $9.314 billion in auto revenues. Of that, though, $401 million was regulatory credits, leaving $8.913 billion revenue. We also know that Tesla delivered 180,570 cars in Q4 2020. Now, if we simply divide that deliveries number into the revenue number, then we get the average selling price of a Tesla, which comes to $49,360. And at 30%, that means that Tesla make approximately $15,000 per vehicle sold. Therefore, anyone who tells you Tesla make a loss per car likely need to believe that, as they missed out on the investment of a lifetime. They can't handle the truth, as Jack Nicholson likes to say. According to Ron Barron's interview, he said that Tesla invested $1 billion into the Shanghai Gigafactory, and now it's making $2.5 billion a year. Sorry, let's just say that again. Tesla invested $1 billion into the Model 3 Shanghai Gigafactory, and now it's making them a $2.5 billion profit. That's a 250% return on investment. So when people tell you they only make a profit from their regulatory credits, the real response should be, yeah, I know, it's such a shame they're making a profit at all. It's a shame they're still constrained by batteries and can't invest any more into factories and make a huge loss. Okay, but can we believe what Ron Barron says? Well, with some quick back-of-the-envelope math, we can see how close it is. If China are doing 200,000 Model 3s a year and making $2.5 billion, then that would imply a profit of $10,000 per car. Given that less Chinese purchase FSD and they sell more standard range than long range, then that feels like it would check out perfectly. Tesla's factories seriously make 250% return on investment in China. Now, given the larger price tag for the Model Y in Germany compared to the standard range Model 3 in China, a higher percentage of customers purchasing FSD, 4680 batteries being used in Berlin, and all the extra gigapresses, then perhaps the return on investment could be even higher in Germany. So, we're seriously not even close to wanting Tesla to pay out dividends to us yet. Not when they're able to achieve such high returns. This is just crazy. But people are more hung up on the fact they only make profits from regulatory credits. But it's all about timing. Tesla are getting good and efficient at making their factories now. So, of course, they could easily enough open up a new factory in more locations. But there is no point if they can't supply all the necessary components, which we are told are mainly batteries holding them back. But it may possibly be semiconductors too, perhaps to an extent. So they build factories with large capacities like Berlin and Austin in time for when they'll be able to supply enough batteries. Although now we're hearing that both Panasonic and LG Energy Solutions, formerly LG Chem, are both going to be making Tesla 4680 batteries, which in my opinion is a big deal. Tesla needs as much help as possible in reaching their battery targets. These two companies have proven themselves in battery production, which is important. Of course, Tesla are already manufacturing the 4680 batteries in their pilot production plant in Cato Road, and will have a much larger facility in Berlin and Texas. As these 4680 batteries cost so much less to produce than the 2170s, this is going to add significantly again to Tesla's margins. And it would appear that Tesla are going to be using the lithium iron phosphate batteries for their standard range plus Model 3 in Fremont now, like they do in China. These are very low cost relative to lithium iron, and will significantly improve margins of the already affordable Model 3. The LFP batteries are something like $5,000 to $6,000 per car, compared to the lithium-ion batteries at closer to $11,000. Don't quote me on that, that's just off the top of my head, but I think it was in the ballpark. Tesla have also stopped taking orders online for the standard range Model Y, although you can still order over the phone, although I'm not sure how long that will last. I think demand is so high that Tesla just want to sell their most profitable models, again improving margins. I would say they will likely only sell long range and performance in Berlin too. Currently Tesla only make around 50% of the FSD revenue as profit. The rest goes into something called deferred profits. Every now and then Tesla makes some breakthroughs with FSD and they're able to justify releasing some of this deferred profit, such as their smart summon feature. The rest doesn't count as profit. In other words, even though someone is paying $10,000 for FSD, Tesla is only counting about $5,000 of that as the margin on the car they sell. The other thing is perhaps only 20% of people in the US actually purchased FSD, and only about 1 or 2% in China. In other words, the more progress Tesla make with FSD, the chances are more people will be ordering it, and it will again improve the average margin per car. FSD is just software. It is no extra expense to Tesla when a customer upgrades. Tesla have been continually investing in new manufacturing processes and techniques, with the likes of the gigapresses, heat pumps, octavalve, continual R&D in FSD. All of these will pay off and further improve margins. Remember, Elon said he expects to improve manufacturing speeds by 10 to 100 times, as unreal as that sounds. In a recent email sent to Tesla employees, Elon has announced that the demand for the new Model S and X has increased so much that they'll be opening a new line. The email reads, Model SX production lines are almost done retooling and will be aiming for max production next quarter. There is high demand, so we will soon need to go back to 2 shifts for S and X. Please recommend friends to recruiting. As S and X is so much more expensive than the other models, we can assume they carry the most margin too. So if sales for these luxury models improve, then the overall car margins will too. Seriously, with the reduction in battery costs, the potential for more people ordering FSD and less deferred profit, along with FSD likely increasing in price over the years, the improved efficiencies and techniques in manufacturing, the increased demand for the expensive Model S and X models, I joke you not, Tesla are on their way to reaching over 40% gross margin on their cars alone. If Berlin is doing 1 million cars, Texas 2 million, China 500,000, and Fremont 750,000, with average selling prices of around $50,000 per car, that is an astounding $20,000 gross profit per car, and with a total of 4.25 million cars sold, equates to a gigantic $85 billion gross profit just from car sales, which is unfathomable. Although with the extra demand for S and X, the Cybertruck, the Model Y demand, FSD price increases, semi-truck, roadster, the average selling price could be even higher. Remember, all the cars they currently sell from Fremont are somewhat antiquated, for lack of a better word, with their old processes of manufacturing. Elon has stated that they could close it down and update all the processes, but the loss of income during that time doesn't justify the extra profit margins. In addition to that, all the other cars they are selling are coming from China, which have a lower average selling price. Berlin and Texas are going to take this company to a serious level. And don't forget, this income is still pale in comparison to the potential of robotaxis. Oh yeah, and energy isn't exactly the smallest industry either. And now with potentially 2 new factories about to be announced in India and England, it might not be long until they're possibly doing over $100 billion gross profit, perhaps in 2023. When they start making that much profit, then I don't know how they're going to spend it all. Maybe they might start buying back the stock. And okay, sure, I know that's not net profit, but you've got to think the stock price must be in excess of $3,000 at that stage. And then, of course, what chance does the competition have? Thanks for listening. Please hit the thumbs up and don't forget to subscribe.